including Barclays Bank, Standard Chartered, Ramco, and TVS Group, and specialization in indirect taxation. So with this brief introduction, I welcome you, sir, for today's session. Over to the speaker.
Thank you, ma'am. Good morning to all the members of ICA Chengalpattu who have joined this session on GSTR-9 and 9C. Now, at the outset, the clarity that we expect, or what I wanted to share with you, is there is no change in whatever we have done for 1920 from what is going to be done for 2021. So don't think that we have been exonerated or removed certain responsibilities away from us. It does not happen. Only one thing is not going to happen, which is the signing of the GSTR-9C, the digital signature exercise, which would have taken us about 3 minutes. That is what has been done away now by the government. So by no stretch of imagination, our responsibilities are not reduced. Neither can we breathe a sigh of relief that it is now assessee's responsibility. Certainly not. And especially when the assessee is going to be the assessee for whom we are going to file the income tax returns as well as the Companies Act returns, as the case may be. And then we do GST, all the more responsible we are. So that is the clarity at the outset I want to give. So no special thing that has happened. And wherever we are discussing this, I will not go through the individual forms and explain. Wherever the critical points, where either the department has picked up in some notices or they have come up with some clarifications. Plus, for this year, what are all the tables that are mandatory? Again, like last year, they have said when they have notified the certification removed 9C and 9 for 2020-21, the same format is being retained. While the format is being retained, there were questions as to whether all the information in the GSTR-9, as it is originally in the form, should we give all that? No, that has also been notified along with relaxations. We will see those also as to what are all those important tables that is mandatorily required to be filled up by us. So that is the preamble I want to set at the outset. And then GSTR-9, when we discuss, we will look at the legal amendment which has been made effective from 1st August 2021 and what is the impact of it in our discussion. And then with respect to annual return, what are the timelines? What is the associated penalties and late fees? And because there are many instances where the audit has been started by the department, either the central officers or the state officers, the audit has commenced. Once the audit commences, then we must be aware as to what are the consequences of not filing or how the department would react when we do not file. And then we will look at GSTR-9 at a macro level and see what are all those points where we can improve or where we should take care of when we are reporting. So then we will look at the GSTR-9C, the critical points about 9C. What is the Finance Act 2021's amendment, which has been made effective from 1st of August 2021, is that Section 35, subsection 5, which mandated GST audit by a chartered accountant or a cost accountant, has been dropped. Section 35, subsection 5 is no more. So what they have done is, in Section 44, which was the original section for annual returns, wherein they have inserted the words that annual return along with a self-certified reconciliation statement. Only when your value of turnover exceeds a particular amount, then you will have to file this reconciliation statement, which is self-certified. So GSTR-9C, all the tables are going to be retained except Part B. Part B is going to undergo a small change, which is a self-certification by the taxpayer. It need not be certified by the chartered accountant or a cost accountant. That is the amendment which has been passed and made implemented from 1st of August 2021. Now here, again, legally, there are people who are asking a question that when the notification has come from 1st of August 2021 only, meaning it was given on 30th of July, stating that it is applicable from 1st of August. With the financial year 2021 already over, financial year 2021 is already gone, and we are notifying it only during August 2021, which means technically for 2021 also GST audit should be applicable, is the question that people have asked. But I have reconciled myself and come to a conclusion that it is not applicable. The reason being, on the completion of 43rd GST Council meeting, the Finance Minister in the press release as well as in the press meeting proudly announced that we have done away with GST audit and it will be implemented from 2021. Legally, even if the department is wrong, they will make a retrospective amendment. Hence, once we know what is the intention is to remove GST audit from 2021 financial year onwards, then I don't think we have any locus standi to fight further or to ask as to question the legality behind this being not applicable for 2021, and they themselves have removed it in the form. So I don't think they can ask us to file when it is not even available in the online form. So there ends GST audit, at least for now. Now the annual return filing from a different perspective. Why we need to look at it is the initiating of any demand and recovery proceedings by the department under section 73 or section 74. I would take 74 for discussion because that gives a longer period of limitation for the department to react. The importance of GST annual return is that section 74 subsection 10 read with 74 subsection 2 gives us a timeline. It says department can issue an order in terms of anything that has happened within 5 years from the due date of filing of annual return. Within 5 years from the due date of filing of annual return for that financial year. So if they want to pass an order in respect of a year, let's say 2017-18, they can pass it within 5 years from the due date of filing of annual return for 2017-18. Now there again, when it is read with subsection 2, it further says that there must be a minimum time limit of 6 months between the issue of show cause notice to the passing of order. 74 talks about 6 months. 73 talks about 3 months. I have not taken 73 into discussion. I am doing only 74. 74 says 6 months should be the minimum period that should be in between show cause notice to passing an order, which means within 5 years from the due date of filing of annual return, order can be passed. But for that, show cause notice should be issued minimum 6 months earlier, which means 4.5 years from the due date of filing of annual return is what we are looking at as the timeline. Now, for timeline for what? Timeline for period of limitation, or the period beyond which department cannot issue any notices. So when we look at it from that angle, for financial year 17-18, 18-19, and 19-20, these were the respective due dates. So 2021 also, this was the due date, meaning 31st December 2021 is the due date. It continues to be the due date. But when it is extended, and judging by the way income tax portal is working, and the finalizations are to happen based upon income tax website, I am led to believe that GST can also get extended. Not because of GST portal issues, maybe because of income tax or Companies Act filing is getting delayed, or there is an extension. Consequently, this might also get extended. Hence, as of now, I'm not discussing 2021. I'm discussing about the last 3 years which have gone by. In these 3 years, had it been the original due dates, these would have been the due dates. But these due dates were extended. For 17-18, we saw that 31st Jan 2020 was the due date, and 18-19, 31st December 2020, and 19-20, it was 31st March 2021. That is how the extension happened. And from these extended dates, if we look at 4.5 years, this is where we look at in terms of issue of show cause notice by the department under section 74 for any demand, initiating of any proceedings by the department. Hence, the criticality of annual return is also from or notification of the due date of annual return. It is not necessary that you should have filed an annual return for this timeline. It is only the due date of filing of annual return which is taken into consideration. Based upon that, these are the timelines up to which for these respective financial years, department can take proceedings, issue notices. This is what we have to keep in mind when we are discussing annual return for any taxpayer. Now, if an annual return is not filed, then what is the recourse that is available in the hands of the department? One, we are liable to pay late fees under section 47 subsection 2. How much is that late fees? That late fees is 100 rupees per day CGST, 100 rupees per day SGST, but subject to an overall maximum of 0.25% of the turnover. So it is not restricted to 10,000. It is not restricted to any amount. It is restricted to 0.25% of my turnover. Let's say the taxpayer's turnover is 10 crores. So 0.25% of that would work to, let's say 25,000. Then in that case, that person will have to restrict his CGST maximum to 0.25%, SGST maximum to 0.25%. We might end up paying 50,000 rupees as late fees. And what is the other recourse that is available with the department? The department, if they want you to file the annual, because non-filing of annual return will entitle me to pay a late fees. But if the department does not want to give me any room for making corrections later on, so they want me to file an annual return, then they have to issue a show cause notice under section 46. Now, this is not a notice under section 61, 62 or 63 or under 73 or 74. This notice has to be issued under section 46, asking me to file the annual return within 15 days. I am supposed to file it within that 15 days. If I do not file, apart from this late fees, any other penalty the department wants can also be levied on me. Now, if I am not filing this GSTR-9 within this timeline or 9C, as the case may be, then in case of 9C, there is no late fees. Only in case of 9, there is a late fee. But in both the cases, department has the power to invoke the general penalty clause under section 125, because there is no specific penalty that has been defined for 9 and 9C non-filing. Hence, they can invoke this section 125 and levy a general penalty of 25,000 plus 25,000. Point to note here is that unless the show cause notice under section 46 has been given, for which we have not responded, or in reply to that show cause notice, we have not filed the annual return, then only this point can be resorted to by the department. Hence, if at all you are receiving a show cause notice under section 46, it is time for us to react. Now let's look at the other parts which are required, which we need to take into consideration while doing a statutory audit from an annual return on the GST's perspective, coupling the GST provisions, which are important as well. Now, the prior period items can arise because of GST. Let me give an example. 2020-21, I have taken ITC. These input tax credits have been availed and I have taken it to my current asset. In the 2020-21 annual accounts, we are showing it as current assets, but we have not availed it in 3B because our supplier has not reported GSTR-1. Because he has not reported his GSTR-1, we wouldn't have received the credit in our GSTR-2B or 2A, as the case may be. Hence, we have not availed the ITC. We are holding it as a current asset in our balance sheet, but not availed in 3B. But by this month, let's say August end, you come to a conclusion, you come to know that the supplier is never going to report that. Now, what is it that we have to do? We have to take it out of our balance sheet, take it to P&L. Suppose we had finalized the annual accounts for 2021. That write-off will have to happen in 21-22 financial books. This is one classic case of prior period items creeping into our audits because of GST. The next situation could be credit notes. Under section 34 subsection 2, credit notes can be issued for the notified scenarios, but that credit note must be issued before September of the following financial year. So here we are looking at a timeline. Any invoice which is pertaining to 2020-21, if a person intends to give a credit note in respect of those invoices impacting GST, it must be given before September 2021 for financial year 2021. So if he is not giving it before September 2021, then the credit note is something which cannot be given with impact of GST. But suppose he gives on 30th September 2021 for the financial year 2020-21, he is giving a credit note, and especially in case of service providers. that credit note will have to be taken into consideration. When is it in financial books of 2021? If we had already finalized it, it has to come as part of only 21-22 financial books. So these are another common scenario where we can see the prior period items creeping in because of GST. The other possibility is contingent liabilities. Why would a contingent liability arise? I'll give an example. It could be contingent liability, it could be certain liability as well. For example, when we are filing an LUT, one of the easiest forms in GST, everybody files LUT, letter of undertaking, and get the ARN, which is considered to be their acknowledgement. Now, based on that, what they do is, whenever there is an export of goods or export of service, they do it without payment of IGST, which is fine because it is in line with the expectation of the person getting an LUT. But if the person is not fulfilling the obligation under LUT, for example, the goods are not sent outside India within 3 months from the date of invoice in case of goods export, or in case of services, the money is not realized in convertible foreign exchange within 1 year from the date of invoice, what happens is that as per the conditions of LUT, it becomes a certain liability. How certain it is it becomes a liability to be paid within 15 days from the expiry of the 3 months or 1 year. That is what is the condition under Rule 96, for which we have accepted and given that letter of undertaking. Now, let's say 9 months have elapsed in case of a service invoice. The service invoice was given 1st July 2020. On 31st March, when we are finalizing the accounts, we know that 9 months have elapsed for this invoice and they have still not paid GST. Now, what is going to be even more interesting is, by the time we finalize the accounts, let's say today we are finalizing the accounts, by 30th June 2021, I know very well that they have not realized the money at all. Till today, they have not realized. Then what happens? It is a certain liability. As on 31st March, it was a contingent liability. But in 2021 June, it has become a certain liability because within 1 year from the date of invoice for the service, they have not realized the money in convertible foreign exchange. This liability, how to quantify, how to report it in the statutory audit ending 31st of March 2021 is something which we need to look at. And consequently, interest is also liable. Not just the tax that is liable, interest is also payable for the 1 full year. That interest is a certain liability. There is no escaping that interest. Tax, there is a possibility that as on 30th of June, that is the completion of 1 year, you have not received the money in convertible foreign exchange. But if you had received the money in July, you are not liable to pay the tax, but you are still liable to pay the interest for delay in collection. Hence, this aspect can result in a huge amount of disclosure in contingent liabilities, service industry especially. And last year, for goods also this is possible because due to corona restriction, not all the shipments were getting exported within 3 months from the date of invoice. And department did not give any leniency in terms of time delay for that. So that is also something which we need to take into consideration from a GST perspective. And then any provisions that we make, would it result in ITC reversal? Because vendor payment liability, which we provide that we don't have to pay, then the corresponding ITC shall have to be reversed. Look at those perspectives. Write-offs, again, of vendor or any inventory, the ITC availed on the transaction with the vendor for which we are not making any payment, or inventory for which we have taken ITC but which is being written off, we have to reverse ITC. 17 subsection 5 clause H makes it mandatory, and the quantification of interest, penalty and late fees which needs to be reported in our GSTR-9, which how to impact in the statutory audits. For example, GSTR-1, as we all know, is a statement under section 37, but there is a late fees for delayed filing of GSTR-1. Thanks to the GST portal, till today, the portal is not asking for that late fees. So many of the taxpayers come to us for filing GSTR-3B, let's say on 19th of the following month. On that day only, they give us the data for GSTR-1 also. And they say, file both the returns. Had they done the same across the year, every month, minimum of 8 to 9 days, is their GSTR-1 belated filing, late fees accumulation. And that late fees, did we provide in the books of accounts? How are we to pay? Now, for the first question, statutory auditor will have to take a call. For the second question, we are supposed to pay. Even the department officers are not aware that such a provision where to make the payment. We can still utilize DRC-03. That is the only option that is available today for making the payment of that late fees. Or if you want to be playing safer, saying that, sir, anyway, we'll provide for the late fees. Let us not pay it. That is also much better. But at least providing in the books of accounts is mandatory. Hence, these interest, penalties, late fees, especially interest with respect to debit notes, delay in payment, quantification does not happen in the portal automatically. We will have to quantify the interest element, provide in the books of accounts the GST liability on the same. If GST has been paid, then interest liability shall have to be paid because interest liability is automatic. There is no period of limitation. Hence, anytime department may ask. So to reflect a true and fair view, our books of accounts will have to have that interest provided. And moving further, the purpose of the annual return and the basis on which it is to be prepared. The purpose of the annual return is we may have committed some mistakes while filing the monthly returns. GSTR-1, GSTR-3B. GSTR-1 at least has an amendment possibility. GSTR-3B is like cast on a stone, so we cannot do anything about it. It is cast on a stone, so we have to live with that. GSTR-3B cannot be amended, but I have a mistake which needs to be corrected. For example, 20 lakhs was my turnover to be reported in GSTR-3B, but instead of reporting 20 lakhs, I added a zero and made it 2 crores. In my GSTR-1, I have reported properly 20 lakhs. In my 3B, I have added 1 zero and wrongly reported 2 crores. But with respect to tax, I have reported only the tax applicable on 20 lakhs. How to correct this? This correction will have to be done only in the annual return. Likewise, many corrections which we want to do in our returns, which were filed in the month-on-month basis during the financial year, will have to be done in the annual return. So, situation 1. Situation 2. When we have finalized our books of accounts, there might be certain transactions or entries which we pass, which may have to be given an impact in the GST returns, which is not possible when we have crossed the timeline of March. Hence, those we want to get accommodated, we can accommodate it in the GST annual return. So this is the basic purpose of announcing an annual return. And what is even more important to note is that once an annual return is filed, we cannot go back. Annual return is final. That's it. Hence, whatever that we want to correct, our last opportunity is annual return. What is the basis for preparation of this annual return? That is where we have to strike a reconciliation between these three. And out of these three, if there is going to be a difference, the three elements that go into the reconciliation are GSTR-1, GSTR-3B, and the finalized books of accounts that you have in your hand. Now, when I say finalized books of accounts, there could be a situation where a taxpayer has got multiple state presence. We are not reconciling with their signed balance sheet and P&L. We are reconciling with their books of accounts for the particular state. Section 36, read with Rule 56, makes it amply clear that books of accounts shall have to be maintained registration number wise. So GST-IN wise, we have to maintain the P&L and balance sheet. If not P&L and balance sheet, at least trial balance should be maintained at that GST-IN wise. Hence, the finalized books of accounts here, I mean, what is the trial balance of GST-IN wise, which goes into getting consolidated as a financial statement for the company as a whole. That one which is pertaining to this state. For example, if a company has got 7 state presence, 7 different trial balances will be there. And these 7 different trial balances, when they are combined, then we have a consolidated one India books for them. Now, in the 7 different trial balances, there is an element of intercompany or intra GST registration transactions, the elimination of which need to be taken care. Post that only, the P&L will get finalized. But from a GST angle, we are bothered only about this trial balance of Tamil Nadu, which is getting into consolidation. Hence, GSTR-1, 3B, and this books of accounts, the comparison should be made. And from there, we will have to finalize the numbers to be reported in GSTR-9. Now, a pointer towards that is, when we look at GSTR-1 and 3B, What are its contents mainly? GSTR-1 gives a document-wise detail of my outward turnover as well as my output tax liability if it is B2B. If it is B2C, it gives a consolidated liability and turnover data. GSTR-3B, on the other hand, borrows the liability data from GSTR-1. So GSTR-3B has something more to it. Only the liability data is taken from GSTR-1. My ITC is reported, but ITC is reported on a consolidated basis in GSTR-3B. And then what is the tax that I need to pay after I offset my input tax credit with my output tax liability? This is what is in 3B. Now, the GSTR-1's liability, GSTR-1's turnover must match with my GSTR-3B outward that is reported. What if it is not matching? That is where we get into a situation of tiebreaker where we have to go to the books of accounts. The audited signed books of accounts relevant for this GST number, that is what should be taken into consideration, and that is the one which needs to be reported. If GSTR-1 and 3B are matching, and books of accounts is also matching with that, it is a, what should I say, utopia kind of scenario where, wow, everything seems to be matching, let's file. But GSTR-1 and 3B are having a discord. Then in that case, which one to go with? Which is the one which is matching with the finalized books of accounts? What is the correct number? Because which is the comparative with which we will find out whether 1 or 3B is correct is books of accounts. 1 and 3B show a different number and books of accounts show a different number. Hands down, books of accounts wins. We still have to report what has been reported in the books of accounts, only in the annual return. So this is the methodology with which we have to approach and finalize our GSTR-9 filing. 3 elements go into the comparative. The ultimate winner is books of accounts. Now, we look at the final parts of GSTR-9. There are 4 major parts. Though part 1, part 2, part 3, part 4, part 5, part 6 department has given in a different way. I look at it based upon the tables which are made mandatory, that it is only consisting of 4 major parts. The first part is table 4 and 5, which talks about my outward supply value and my tax liability. And the next tables, table 6, 7, 8, which talk about my input tax credit. What is my input tax credit? What is my reversals that I need to do in table 7? And what or where do I stand with respect to GSTR-2A matching in table 8? So this is the ITC related matter that I need to see in my GSTR-9. And then table 9, table 10 to 14. What do they carry? Table 9 gives the liability that I have expunged during the financial year by way of my 3B, either utilizing ITC or by payment of cash. From 1st April to 31st March, returns that have been filed. Plus anything pertaining to this year, that is the year in question, 2020-21, for which the tax has been paid in 21-22. Any ITC pertaining to 2021, but the ITC has been availed in 21-22. Those needs to be reported in 10, 11, 12, 13, and the consequent tax impact on that shall have to be reported in table 14. So this is the third element which I consider necessary, or third part which we need to do the reporting. And finally, we have this all and sundry clauses or all and sundry tables. Table 15 to table 19. These tables I've given it at the last because these tables were not mandatory so far till 1920, and good that in the notification that has come for the revised GSTR-9 and 9C process also, these tables are redundant. It is optional for the taxpayer to report the refunds data, the demands data, or the HSN level data. So it is not mandatory. We don't have to report this fourth part. So the focus shall have to be on the first 3 parts, which we will discuss in detail. Now, when we enter into our annual return, you will see these 4 tabs, very, very important. If you are using any other software for filing GSTR-9 and 9C, you might get this data readily from there also. If you are somebody who's depending on the GST portal only, then I would suggest to take a look at these 4 tabs, because One, it gives GSTR-9 system generated copy, download and keep it so that tomorrow we will know what is the change we are making in GSTR-9 only based on this tracking. Second, GSTR-1 summary and 3B summary, very useful. The cumulative 12 months figures are reflected in GSTR-1, how much we have done, and 3B, how much we have done. For us to identify the 3B, 1 versus 3B differences, this will be very useful. And the last one is really, really useful because what is the ITC that has been reported against our GST number by our vendors? How much of ITC we stand entitled to? That is reported in table 8A. And that number which appears in table 8A, what is the invoices breakup of it? The answer to that is in the 4th tab, table 8A document details. Because if we find that there is a difference, then we may have to intimate to our vendor to do the reporting properly. Hence, table 8A is very, very important. These 4 we can readily download and keep it. Table 8A comes in Excel as well, so we can use it for further data analysis. Now, looking at table 4 and 5, what is it that we need to report? B2B, B2C. Yes, we know that already, so I'm not going to bore you on that. But in B2B, we need to be careful because the notification number 40/2017 related turnover, that is merchant export transactions. That is, I am selling it to a merchant exporter, and that merchant exporter is exporting. Then my transaction to the merchant exporter under notification 40/2017, he says that you charge me only 0.1%, and he has to give the documentation as required under notification 40/2017. So as the person who is finalizing their GSTR-9, though it is assessor's responsibility, maybe as a person who is looking at their 9C or doing their statutory audit, we must ensure that 1, the documentations are received properly or not, and 2, the 0.1% turnover is not to be reported under deemed exports. It is a transaction of B2B only, because I'm making it to a person or I'm supplying to a person who's in India. So I need to report it at table 4B. This is a common mistake that many have committed, where we need to be careful and we need to report it here only. And then deemed exports do have a separate reporting to be done, which is in table 4E. Now, what is this deemed export? Notification number 48/2017 brings about 3 different scenarios, 4 as envisaged in the notification. Those scenarios, if you have done any transactions, supply to an EOU, supply to an advance authorization holder, or supply to an EPCG holder, all this, we may have to bring it under deemed export category. And that needs to be reported here when we have done the transaction. And then what we need to look at is the most important, zero rated transactions. In case of zero rated transactions, whether it is with payment or without payment, if it is with the payment of IGST, zero rated, which are in the nature of export, or zero rated, which can be supplied to SEZ. When it is with payment, then we report it in table 4. When these 2 are done without payment, we report those respective numbers in table 5. Wherever we may report, where we have to be careful is whenever we are doing the zero rated transactions, especially exports of goods or services. Rule 96B has been inserted from 24th March 2020, which states that in case of export of goods, if a person intends to obtain refund, he needs to prove that he has realized the money in convertible foreign exchange within the FEMA time limits. The time limits are not fixed under GST law. It is borrowing the time limit from FEMA, which is generally on a sale transaction of exports from India. It is 9 months. We are supposed to realize the money within that time in case of export of goods. There was no such requirement or restriction to realize convertible foreign exchange in case of export of goods till March 2020. It has become applicable only from March 2020. In other words, for financial year 2021 only, it is fully applicable. So any of the exports that we have done, have we realized the money within 9 months export of goods? But here we need to be understanding the provision one more step further, which says only if you are applying for refund or only have obtained the refund, this becomes mandatory. Which means if I have done any export of goods and I am not intending to get refund from the department and I have not realized the money within 9 months from the date of exports, I don't have to do anything. I am still well within the law. But if I have done export of goods. I have applied for refund. I have got the refund as well. It could be with payment route or ITC route, whichever it is. And I have not realized the convertible foreign exchange within 9 months. There I run into an issue. I will have to give back the refund that has been taken by me along with interest. Contingent liability, certain liability, qualification can arise from this. So zero-rated transactions, generally what we report will come, but the check that we need to do is this. Now, the other element is with respect to the advances. Now, advances that need to be reported during the period, we must take care to report only the net advances. That means advances taken during the year, invoiced during the year, then that need not be reported. Only advances which have been reported during the year as received, but which are still not being invoiced, alone needs to be reported in 4F. Debit notes and credit notes and amendments. Like 2019 and 20, for 2021 also, there is a relief. The relief is that debit notes and credit notes, if you intend to report, you can report it individually in these parts, that is 4I or 4J. If you intend to report on a net basis in table 4ABC itself, we can do it in the respective places itself. There is no need to report the debit or credit notes separately. It is optional for this financial year also. Moving further, the connected tables with 4 and 5 is 10 and 11. This is very, very important because in the GST return for 2021, I have missed to report some liability. That liability, I am going to include it in my financial books of accounts as on 31st of March. If that is the case, you should report that liability somewhere. Where to report? Report it in the subsequent period, which is between April 2021 to September 2021 returns. Within this time, if you are able to report it, then you have to capture it here. Details of data pertaining to previous financial year, but reported in the subsequent financial year. It could be an increase in the taxable value on tax value. It could be a decrease in the taxable value on tax value. Increase means table 10. Decrease means table 11. That is where it has to be reported. Now, our turnover will be a combination of all this. Table 4, table 5, plus table 10, minus table 11. This is what is the turnover, which will be compared for the purpose of our GSTR-9C. What is the number reported in P&L? The comparative will start from here. Hence, reporting this 10 and 11, even though it is optional given by the department, I feel that we should take care of this. Hence, to avoid the problem in the next year's return, because in the next year return, these turnovers would be reported, but these turnovers would not pertain to that year. So we may have to remove it and reconcile. Hence, ensure that this is being taken care. So table 4, 5, 10 and 11 cumulatively will address our liability related disclosures. Because of this 10 and 11, there is a liability that is arising. Liability pertaining to 2021 reported in 21-22. That should have been expunged to the department, and has it been done? How much of that amount has been paid shall have to be reported in table 14. So how much is payable and how much is paid. So this is also a data which we have to bring it into consideration when we look at output tax liability from GSTR-9 perspective. And then we look at the ITC element of GSTR-9. Table 6A of GSTR-9 is pre-populated with the ITC that we have availed during the financial year. During the financial year 2020-21, by way of filing our GSTR-3B for the 12 months period from April 20 to March 21, whatever ITC we have availed, everything will be totally reflected in 6A. What is reflecting here in total? We may have to split it and report. How to split it, or what is the split that is expected? How much is reverse charge? How much is the import related transactions, import of goods, import of services? How much is ISD related ITC that we are availing? And then obviously the remaining B2B transactions. And inside these 4 major categories, we have to further subdivide into how much is input, capital goods and input services. Here as well, what we did in 2019 and 20, the same relaxation or relief has been given for 2021 as well, which is we don't have to split and report input and input services. We can combinedly report input and input services in one line, but capital goods related ITC will have to be split and shown. So capital goods, input and input services can be the two broad subdivisions under which we will have to report this ITC. So what is the ITC for which I have availed ITC in my 3B? I'm only giving a breakup of it. I'm not going to give anything new, neither am I entitled to take fresh ITC in my GSTR-9. That point we have to be careful, and then we are only giving a breakup of what has been reported in GSTR-3B, where there is a possibility that we may have availed, apart from these four scenarios, some other ITC, like the ITC of Rule 37, which is possible. Why I'm talking about Rule 37 here is, you should not take it under B2B. You should report it separately. 6H is the place. What is Rule 37? Failure to make a payment to the vendor within 180 days from the date of invoice. If I do not make a payment to him within 180 days, then I am liable to pay or liable to reverse the ITC that I have taken. So when I reverse that ITC in that year, let's say in the previous year you have reversed the ITC, subsequently you become entitled to take that ITC whenever you make the payment. 37.4 gives me that enabling provision. Whenever I make the payment, I become entitled to take ITC. That time I will avail that ITC. When I am availing that ITC, reclaimed ITC, it will not be reflected in my 2A because it was last year's invoice. It would have been there only in the last year invoice, last year 2A. It will not be reflected in current year 2A, but I would have availed that ITC in my 3B. So that split has to be given separately. In 6H, reclaimed ITC. Once this is done, our first part of ITC element reporting is done. Tran credit we may not have unless we have ITC 01 and 02, which is newly incorporated associate. If that is what they are going to do, or by way of merger or acquisition it has been formed, ITC 02 would come. So those ITCs will have to be accounted in 6M. Exceptional situations. Once these are done, we are done with our first part. What is the ITC that is taken by me? I have given the breakup. Now, out of this ITC that is taken by me, we need to report our reversals. What are those reversals? Rule 37, failure to make payment within 180 days need to be reported. And then Rule 39, ISD credit notes. ISD itself is a rare scenario. Suppose somebody has distributed the input tax credit by way of ISD and subsequently they realize that they have over distributed. Could be various reasons. They want to reverse that. They can do it through an ISD credit note. That reversal will have to be shown in 7B. And common ITC reversal for input and input services, when my output is having both exempted as well as taxable. When I deal with outputs which are both taxable as well as exempted, then I'll have to reverse the common ITC pertaining to input services. That is covered under Rule 42. Pertaining to capital goods, that is covered under Rule 43. So these reversals I will have to carry out, and that I need to report it in 7C and 7D. A common area where we have seen many taxpayers will not do this. They would not have done it on a monthly basis itself. But when we are filing GSTR-9, it will become our responsibility to intimate this to them, do the calculation or make them do the calculation and do the reversal. Now, to the extent of reversal here, a P&L hit entry may have to be also passed, because to that extent, your current asset is no more your current asset. It will have to go into P&L. Hence, important from both audit finalization as well as GST reporting perspective. Rule 42, 43, only for those taxpayers who have got common input tax credit, both for input and input services as well as capital goods. And then we look at the ineligible or the blocked ITC. Blocked ITC, we do the audit procedure. We will be able to find out that all these ITC that have been availed, whether they are genuinely eligible or is there a restriction or a blockage of ITC in section 17, subsection 5. If it is there, we may have to indicate that, and that reversal will have to be carried out in 7E. Now, when we do this reporting of 7E, we need to be mindful of the fact that if the taxpayer in table 6, that is while availing in GSTR 3B itself, this person has availed after removing 17 subsection 5 blocked credits, remaining only he has availed, then we don't have to report this here. Unless whatever he has availed in 3B, we feel that there is a blocked credit which has been wrongly availed. There are taxpayers who report all the ITC in GSTR 3B and show the blocked credit separately as a deduction from that. For those people only, this table has to be mandatorily populated, because if we do not populate this, then we'll be misreporting. The ITC reported will be on a higher side. Hence, look at how they have done. It depends upon how they have reported in table 6A, which is a culmination of GSTR 3B. How they have reported in that, depending on that, populate the table 7E. And tran credits, if still issues were there in 2020-21, there were reversals, that needs to be taken in table 7F and 7G. 99.99 cases, I would say it wouldn't be there. Now, once we have reported these reversals, we need to look at any other reversals which we intend to do, where we need to prescribe the reversals. The taxpayer will have to pay the reversal amount through ITC, so DRC 03, which we may have to suggest to the taxpayer. Once this is done, the net ITC, which is eligible, which is only allowed for the taxpayer, will get reflected in table 7J. My table 6 contained the breakup of ITC less the reversals done in 3B as well as prescribed fresh during our process will come in table 7. Net of these two, table 6 ITC less table 7 reversals, we'll end up with 7J, which is my ITC actually available for utilization. Combining these two in table 9, we will see what is the net liability. But prior to that, there is one more a check or a control point, which is table 8, which reflects the ITC as per 2A. For financial year 2021, we still have to go by 2A for the major part of the year, because till December 2020, we had only 2A. Only from January 2021, 2B was introduced. So in our GSTR 9, table 8, 2A will have to be the point of reference for reconciliation. What will be reflected in table A is what is the list of those invoices reported against us by our vendors. For this only, we saw at the start of the GSTR 9 itself that there is a download that we can do with the invoice level breakup of what has been reported here. Let's say 5,64,576 is the IGST reported against me. What is the invoice wise breakup of it? I can see it in table 8A's breakup. In the GSTR 9 itself, I can download it, which will immensely help us in reconciling. And here, if there is going to be a mismatch, there will be a certain possibility of a mismatch. 100% I am saying this table 8 is not equipped to handle that. How? Last year ITC availed in the current year, that needs to be reported. There is no place for reporting it. March month invoice, let's say 2020 March invoice, we would have accounted it in April, and given the lockdown situation, we would have accounted only in June and availed the ITC in June return. Then where is the question of that getting matched in the current year? That is reported in the current year but matched in the previous year. Same way, this year we would have booked a lot of invoices, meaning our supplier would have booked invoices against our name. This year March, all that would get reflected. But unless I receive the goods or services, I cannot take ITC. Because of that reason also, there is a timing difference. Possibility of these ITC being availed in 21-22, but it will get matched only in the financial year 2021's books of accounts or 2021's 2A. So that is not readily addressed in this table 8. So my suggestion is prepare a separate reconciliation and if possible, upload it in the 9C. If it is not possible to upload, keep it as part of the working paper. Tomorrow we will be able to substantiate as to how much we had availed. One. And second, considering the fact that this 2A population can become dynamic up to the due date of filing of return for the month of September 2021. For that month, what is the due date? The due date is 20th of October 2021. Till the time, my counterparty, my vendor, has the possibility to report the invoices and I have the possibility of matching it till the time. He may report it after October 2021 also. Him reporting after October 2021 will enable him fulfill his liability, but I will not get ITC because my matching should have happened in the 2A, which he has filed before the due date of filing of the return for the month of September, which means it is advisable not to freeze this data or not to file the annual return unless everything is matched. If it is not matched, you still have an option to wait up to September. Hence, wait up to September's return and then go for table 8A reconciliation. September's return due date is 20th October. Then do this 8A reconciliation is my suggestion, because then only whatever ITC we had last hope that the supplier will report may get reported, and that we may take into consideration. So once we conclude what is the finalized ITC in table 8, remaining we may have to suggest a reversal as well. That again will have to go to table 7 because I have availed, but that person has not reported. So whatever is availed shall have to be reported. Any other reversals we may have to ask them to reverse it. And with respect to ITC also, there are two tables that I need to populate. Table 12 and 13, that is ITC pertaining to last year, that is 2021, which is reported in 21-22. Reversals pertaining to last year, that is 2021, but which is done in 21-22. Both will have to be reported, table 12 and 13. These two tables, again, are not mandated. We may take an option not to report it. It is allowed as an option not to report, but my suggestion for keeping up our reconciliation proper, it is better to identify this data and report it. Else, our 8A reconciliation, that is the reconciliation with GSTR-2A, may not give us proper data. Hence, we may have to take care of this 12 and 13 as well. Like 10 and 11, in case of output liability, 12 and 13 as well, we need to consider it as mandatory and do it, though it is given as an option. Only when this is done, we would know what is our output tax liability, culminated output tax liability, table 4 and 5, with table 10 and 11. Same way, what is our output input tax credit, table 6 and 7, subject to table 8. Then we venture into the last part, the last useful part of GSTR-9, which is the tax liability table, where only one column is allowed to be fed in as data by us, which is tax payable. What is paid through cash and what is paid through ITC is defaulted from our GSTR-3B filing. So that is not something which is editable. What can be edited and reported by us is only the tax payable. There is a possibility that additional liabilities might creep in because of GSTR-9. Additional liability will be reported. Due to that, the liability can get increased. That is the table 9, first column, tax payable, can undergo a change. We will have to make the change and report the revised tax liability. And any difference between the tax payable and what has been already paid shall have to be paid using DRC-03. And there again, should it be paid by cash? Should it be paid by ITC? I leave that open, because in the press release, department has said that it has to be paid by cash. But in the GST payment related section 49, there is no mention of it. That such liability shall have to be paid only in cash. It is not mentioned in section 49. Neither in the rules it is mentioned. It is only mentioned in the instruction to fill up table of GSTR-9. There only it is mentioned that any liability arising on account of this shall have to be paid only by cash. So I leave that open for legal debate. But for me, if an additional liability is arising, it has to be paid, be it ITC or be it the cash that is utilized for making payment. Payment has to be made under DRC-03. So table 9 is the one where we will be able to reflect the additional liability. So table 4, 5, 6, 7, 8, 9. That's all. These are the worthwhile tables that we need to break our head in GSTR-9 for. Remaining tables 10 and 11, 12 and 13 will get combined with 4, 5 and 6, 7, 8. Apart from this, what lies is, as I said earlier, refunds, data, demand raised on the taxpayer during the year, and HSN. These data are optional. So like we have not touched these data for 2017-18 till 19-20 for 3 years, we may exercise the same option and decide not to report this. because it is not mandatory. If you decide to report, yes, you may go ahead and report. There is no stopping. But would this kind of data be available to the taxpayer is a question. If it is not available, it will be a better practice to initiate such data collection for 21-22, but not attempting it for 2021, because 2021 they have already notified that it is not mandatory. So why break our head on 2021? At least prospectively we can ask our assessees to prepare this data. Now we get into our next part. Having finalized our GSTR-9, from the GSTR-9, the 9C will have to be populated. So 9C, the provisions earlier stated that aggregate turnover exceeding 5 crores, then 9C audit by chartered accountant or cost account was mandatory. Now this audit has been removed. Filing of 9C is still governed by this 5 crore turnover. So if my turnover is exceeding 5 crores, filing of a reconciliation statement is mandatory. So this reconciliation statement is not currently appearing in the website automatically. It says once you file your 9 only, we will make that appear. So we'll have to wait and see once we file some of the GSTR-9s how this 9C appears. But there is no change in the format. Format and all have been retained as the same, which majorly covers these areas. Though it is divided into 5 parts, again, only 3 major parts that we need to look at. The outward reconciliation and the output tax liability reconciliation happens in part 2. Tax paid reconciliation happens in part 3, and input tax and input tax related reconciliation happens in part 4. That's all. So these are the things that one may have to pay attention. Only these 3 tables we need to pay attention, and any additional liability recommended. Earlier it was auditor's recommendation. Now there is no auditor's recommendation. Any additional liability identified during 9C process, assessee can pay. Now who would do that? Assessee will always identify and pay during 9 itself. If he does it in 9C itself, or if he doesn't do it in 9, does it in 9C, still the same effect only in respect of the assessee. So you can choose to do whether in 9 or 9C. And a self-certification by the taxpayer for filing the part B. So this is the macro level view of GSTR 9C. Now let's delve into the details of 9C, wherein the other key elements which have an interaction with 9C is that when we do an audit or when we facilitate filing of 9 and 9C by the taxpayer, what we need to look at is that normal situations, what is the record retention period in GST? The record retention period is 72 months from the due date of filing annual return. Similar to what we took up for discussion, 74 subsection 2 and 74 subsection 10 for finding out the period of limitation, running from the due date of filing annual return. The same we may have to take into account one more time for finding out the 72 months. Because for 17-18, since the due date was extended up to 31st of January 2020, which is something like 2 years or almost more than a year. To that extent, the record retention period is also increased. The record retention period also starts only from January 2020, 31st for another 72 months. So we may have to end up keeping those records for 17-18 for 72 months. That is 6 years from 31st Jan 2020. Overall, it might exceed 8 years. That is the amount of period for which the assessee may have to maintain the records, which might be more than the time for which they are expected to maintain the records under Companies Act or Income Tax Act. And when it comes to any records which are relevant because it has been subjected to an appeal or revision proceedings, then that record will have to be maintained for a period of minimum of 1 year after the appeal or revision or the proceedings have been disposed, or the overall time limit of 72 months, whichever is later. So accordingly, the taxpayer will have to maintain it. The records which are required for the purpose of the reconciliation. Now the GSTR 9C, how we should go about the reconciliation is table 5. The outward reconciliation is in a certain structure or a format. I don't want to go by that format. I want to mix and match because I want to take only those relevant lines and discuss. And here I have to give you a word of caution or a word of encouragement. The department has said, though we have got multiple lines, you don't have to worry. You can report all the numbers, that is the total difference under 5O as any other difference as well. So department this year also is extending that relief. But if you do that, will you be able to answer the department officer at later point of time? Hence, my suggestion, don't do that. Do this reconciliation religiously. Now 5A is the place where we report what is the reflection in the books of accounts. In other words, if there is a P&L, assume for a moment that we are doing it for a single state registered person, Tamil Nadu registered person. He has got a P&L. That turnover as per the P&L is what we will have to populate it in 5A. To that, we have to do two important adjustments depending upon the nature of the business of the taxpayer. He could be an infrastructure business or he could be a service provider, because those are the situations where you will see that advances become taxable. We need to pay GST on advance, but it will not become part of my turnover. Same way, I will have unbilled revenue, but I will be doing continuous invoice. In those cases, there will be an unbilled revenue which will be recognized for the purpose of P&L, but that would not have been recognized in the GST return for that month. For example, 31st March, they would have realized and they would have booked a unrealized income or unbilled revenue. GST invoice would have been raised in April, because we still have a time limit of 30 days within which invoice can be raised from the date of completion of service. From an accounting perspective, revenue would have been realized. From a GST perspective, turnover would not have been reported. Hence, so those situations can also give rise to a difference between turnover as per P&L versus the turnover as per GST returns. How to address that? That is what is 5B, C and 5H and I have in common. 5B and 5H have a connection. That is, unbilled revenue at the beginning of the financial year need to be added to my P&L turnover, less unbilled revenue at the end of the financial year, because we are trying to reach GST turnover. So unbilled revenue at the end of the financial year will certainly be not forming part of my GST turnover. So that needs to be removed. But what was unbilled turnover of the previous year coming into this year as opening will have to be added, because that would have been invoiced during this year. P&L wise, it wouldn't have an impact, but GST wise, it will have an impact in this year. Hence, 5B, unbilled revenue at the beginning of the financial year to be added. Unbilled revenue at the end of the financial year, 5H, need to be deducted. The next element is advances. Advances work in the opposite direction. Advances received during the year means you will pay GST, but it will not be taken as part of the turnover, because it is still an advance on which you have paid GST. The compulsions of section 13, which says that time of supply would have occurred the day you receive the payment. For that purpose only, we make the payment. It is not my turnover advance. So advances which are outstanding at the beginning of the financial year will have to be reduced in 5I, whereas advances which are outstanding at the end of this financial year will have to be added back. So what was opening advances unadjusted will have to be deducted, and what is the advance that is still remaining unadjusted at the end of the financial year need to be added. These two adjustments are done, then our P&L turnover will now be ready to be compared with GST turnover. Further, we have adjustments and appropriate lines to disclose those adjustments, which is deemed supply, 5D. What is this deemed supply and what needs to be reported here is the intra transactions. Within the company, within the organization, stock transfer, within the organization, cross invoicing, those will have to be reported. And the deemed supply, other than this invoicing, but which get attracted, agent principal transactions. And then ITC availed assets are given away free. Para 1 of Schedule 1, those transactions will have to be reported here. Where a supply is assumed and tax liability arises only in GST, but in P&L, there is no question of it impacting the P&L, there is no income. But that needs to be reported. Only then we will be able to match our P&L turnover with my GST turnover. So this deemed supply needs to be added to our P&L turnover. 5G ideally should not be there, at least in the revised form. I am assuming that they will remove it, because It was relevant only for 2017-18 financial year. The next one is our interesting area, credit notes. Credit notes split between two situations, credit notes and trade discounts. Trade discounts also are also given by way of credit note only, but a separate way of reconciling is suggested. First part is credit note issued after the end of the financial year, but reflected in the annual. Though it is given after, that is, it is reported sometime in April, May, June, July of 2021. But the impact of it is given in GSTR-9. Then that needs to be deducted here, 5E. Because to that extent, GSTR-9 turnover will be lesser. F and J have something in common. That is, both are credit notes only. But trade discounts is discussed in 5F. 5J, other than trade discounts, credit notes are discussed. Trade discounts accounted in the audited financial statement, but are not permissible under GST. Maybe it doesn't fulfill the conditions required under section 15, subsection 3, clause B, which says that it should be pre-agreed, other party should reverse ITC, all the conditions are required, but the conditions are not satisfied, then it might be shown as a reduction in your P&L because it would have reduced your turnover to that extent. But from a GST perspective, that turnover never got reduced. GST turnover never got reduced. So 5F should be added. Same way, any other credit note other than discounts, credit note that are given but which are not permissible under GST shall have to be added in 5J. 99% of the cases, it will fit within 5F only. Very rare that we have a scenario which will come in 5J. A credit note is issued but not permissible under GST, but possible. For example, a sales return. I have made a sale in 2021. The return is coming only in October 2021. That means I can give him a credit note, but I cannot give him a credit note with the GST. Because I should have given a credit note before September 2021. That is the last date, 30th of September 2021 was the last date before which I should have given a credit note for financial year 2021. But my customer is returning the goods only after September 2021. Then I will have to give him a credit note, but I cannot touch GST. Those can come here. 5J, which can get added up. Now, the remaining sundry elements, whatever we saw so far, are the most operating part of this reconciliation. Remaining are only things which may or may not occur. One is the SEZ related line, which is 5K, which is irrelevant for all of us, except if you are doing GSTR-9 for an SEZ. Because an SEZ making a turnover to a person outside the SEZ, that is in a DTA, domestic tariff area, that is technically a transaction taxable under customs. It doesn't come within the purview of GST. So they cannot report it basically in their GST returns. But that amount will form part of their P&L. So how to eliminate that and match with the GSTR-9? For that purpose, only 5K is inserted. So unless we are doing the GSTR-9C for a SEZ who has done this transaction, 5K is redundant, irrelevant. 5L is a situation of extraordinary brilliance by the taxpayer, who was a composition taxpayer for some time and later on became normal taxpayer and later on became a taxpayer whose turnover exceeds 5 crore, so that he becomes a person who is mandatorily required to file GSTR-9C. So if that happens, then maybe that brief period during that year for which he was a composition taxpayer, that may have to be reported here. In 5L, again, a very, very rare scenario. 5M, valuation related adjustments, important. For income tax purpose, reimbursements will be shown as part of the income or turnover. The reimbursements which have been spent, expenses will be booked in the corresponding debit side. So there will be an expense, there will be an income, both will inflate the expenses. The expenses will be part of expense and the reimbursement received will be shown as part of income. So your turnover might be shown as a little higher because of these reimbursements, but technically speaking, if you have incurred those reimbursements as a pure agent covered under Rule 33, there is no need to pay GST on the same. So your taxable value will be different compared to your value on which tax is levied. Hence, that adjustment need to be reported in 5M. Possible scenario. And then forex fluctuations need to be reported in 5N. Forex fluctuation which has resulted in a reduction or an increase in the turnover. which in GST terms, there is no forex fluctuation that needs to be reported, but in books terms that need to be reported. Hence, if it is appearing in our P&L to that extent, it has to be added or reduced to arrive at GST turnover. And finally, the omnibus clause, anything which is not listed above. So the last resort is 5O. When you do not know where it can be fitted in the above discussion, then finally we can fit it in 5O and close it. But whatever is reported in 5O, department during their audit are seeking extensive data. Hence, when we report in 5O, we should also be clear in reporting that and saying why we have resorted to 5O. Table 7 has hardly anything to do with respect to tax liability, because the turnover that is reported in table 7 is only those turnovers on which there is no liability, like a zero rated under LUT or an exempted or nil rated or non-GST turnovers. So which is as reported in GSTR-9, we can replicate it here. It will not have an impact on the tax liability, but it will have an impact on the overall turnover reconciliation. And the table 9 of GSTR-9C, where we will have to reconcile the tax paid with the tax payable. What we did in table 9 of GSTR-9, we will have to do it here in a different iteration. That is, we'll have to do it rate wise. And here we have to take into consideration rate wise, not just our output tax liability, rate wise our reverse charge liability as well need to be reported here. And this in total should match with our payable. Ultimately, what is payable and which is paid in the subsequent year also shall have to be considered to tell the department that so much has been paid in the subsequent year. So, table 9, read with 10, 11, 12, 13 and 14 will play a role in this reconciliation. Here, for 2021, department has made a small change. That is, they have inserted one line called others. Why that line was required is, for real estate transactions especially, there is no specific percentage that is disclosed in table 9. That is 3.75%. That is not there. CGST 3.75, SGST 3.75. For those of us who are wondering how 3.75% is there, in real estate related transactions, there is no 5%. It is 7.5% only. After 1/3 deduction from the total value towards land, on the remaining 18% is to, or remaining 7.5% is to be levied. But what we do is that instead of reducing that 1/3 from the taxable value and then charging 7.5%, we assume that we can do it totally. That is, on the total take out 1/3, meaning on the rate 7.5%, take out 1/3, 5%, and we think it is 5%. It is not 5%. Tax rate on real estate transactions, affordable residential housing transactions is 3.75 plus 3.75. There is no separate line to report that. That is why they have given that others where we can report it. So the cross section of the reconciliation of tax paid rate wise needs to be done in table 9. Once that is done, all we are left with is ITC related reconciliation. And this ITC related reconciliation again is optional for financial year 2021. And I don't see any value addition in this ITC related reconciliation, because this reconciliation we are not comparing with the ITC in no way. We are not neither checking it with the electronic credit ledger, because if you do it with electronic credit ledger, then refunds will have to be brought into picture. So it is only a comparison of ITC availed, not the ITC balance. So where to pick up this ITC availed? We cannot take the 31st of March balance also. We'll have to go to the books of accounts and find out what is the ITC availed as per books of accounts, not the ITC that is remaining in the books of accounts. So this data has to be prepared, or the assessee will have to take some time to prepare this data, and how we will verify it with the balance sheet itself is an exercise. And then we will have to report what is pertaining to earlier year availed in the current year, and what is pertaining to this year availed in the subsequent year. This piece of data in 12B and 12C, I would say, is important. Hence, this table we may consider populating, though it is optional. And then this has to be compared with what is the ITC that is claimed in 9. Any difference will have to be substantiated. If the unreconciled ITC is more positive, then our books is carrying ITC, which is no more an ITC. We may have to write it off in the books of accounts. If the difference is negative, that means that we may have availed ITC more than what is eligible for us. Then from a GST perspective, we may have to pay back that ITC. with interest to the department. That is what is the interpretation that we can take away from this table 12. So these key tables, table 5 and 6 of 5 and 7 of GSTR-9C, table 9 for payment and table 12 for ITC. If we can take care, 9C is also done. So broadly, these are the tables in table GSTR-9 and 9C that we need to be filling data. We need to be checking the appropriate points in this. And whatever is the additional liability that is arising, like I discussed earlier, should we pay it by using a DRC-03? Yes. But should it be paid only by cash? That is department's expectation, which is open for litigation because there is no specific such restriction in the section. It is only given in the instruction to the rules. So if we attach the sanctity to the rules to the extent to the instructions as well, the same sanctity to a rule is given to the instruction as well, then we may still be duty bound to pay it only by way of cash. And that is where I think some of the assessees may have a different view. We may have to take up litigations in the future. But once we pay this liability, GSTR-9 table 9 compared with GSTR-9C table 9, liability arising and paid, the GSTR-9C reconciliation is done and dusted for the financial year 2021. So that is all I had in my mind with respect to the key points of GSTR-9 and 9C. So what I'll do is I'll now stop sharing my screen. Any questions that you may have, I will address those questions. Whichever way we can take the questions based upon the organizer's comfort. Either we can post it in the chat box or we can unmute you, whichever way the organizers want to do. That way I will take up the questions. Over to the organizers for taking questions.
Members, if there are any questions, you can post it in the chat box. Sir, actually, I have come across a scenario where the client is asking, can we issue a credit note now on the current date, but the invoice has been issued in the previous financial year, like 17, 18, 18, 19, because now it has been delinked, sir. So in GSTR-1, so the system also allows to file the credit note. So that, is it correct, sir, actually?
Classic case of GSTN working in one direction and law working in the other direction.
Yes.
We are governed by 34 subsection 2. It says that for an invoice, if you want to issue a credit note, it must be before September of the following financial year. So for 17-18, just because the system is allowing, we are not supposed to do that.
Yes.
The delinking of credit notes was with a different perspective. That is, every credit note related invoices had to be reported multiple times. Let's say automobile ancillary unit, 2000 invoices, they had issued retrospective credit notes. So they had to upload 2000 credit notes. So to avoid that, additional work for them, department had notified that you may delink, but still it is, the delinking is subject to the overall legal provision only. So as per the overall legal provision for 2021 up to 30th September 2021, I can issue credit notes, not anything before that.
Okay.
If you still want to issue credit note for earlier years, that is 17, 18 or 18, 19, you may do so, but you cannot touch GST part in that. That is what is called as a financial credit note.
Commercial or financial credit notes.
Yes.
Sir, as of now, there are no questions in the chat box. Sir, this ITC portion, is it relaxed, sir? The breakup of the input tax credit, is it relaxed for this year also?
Yes, the same provision as it prevailed for 1920. That is, input services can be disclosed in one line. Capital goods related ITC alone needs to be shown separate.
Okay.
In table 6.
Okay. So I hope our members are very clear with the presentation. I think there are no questions till now.
I have one question. Sorry.
Yes, ma'am, please.
Sir, we are talking about this credit note, like financial credit note and commercial credit note.
Yes.
With this financial credit note and commercial credit note, what is the liability of the buyer in this such a case with respect to reversal of ITs?
Okay. There are two schools of thoughts. I'll tell you both. One is, I have procured something from you, and later on I'm insisting on a credit note. You are giving me a credit note, which is a financial credit note. 100 rupees was the value of the goods. You charged me 100 plus GST, I paid you, and you have remitted the GST to the department. Now, when you are giving a financial credit note, you are reducing your 100 to 90 by giving me a credit note for 10 rupees. The department cannot question this 10 rupees because it is only a reduction in the value of the original supply and it is not a supply by itself. So ideally speaking, department should be happy since the transaction value between us is only 90, but we have ended up paying GST on 100.
Exactly.
So ideally I should have paid only 16 rupees 40 paise. Instead I have paid 18 rupees to the department. Department cannot question this. But where this can become an issue is the deeming fiction under rule 37. That is, to this extent, the payment has not been made within 180 days. Is the deeming fiction that some people are bringing into the fore and saying that, see, this 10 rupees you have not paid to him, which means to this extent you become disentitled for the ITC. You should reverse the ITC. But there again, I have a different view. I feel that only when there is a failure to make payment within 180 days, that reversal will be called for. Agreeing not to pay is not a failure to pay. Both of us have mutually agreed that I will pay you 90 rupees plus 18 rupees. Where 108 rupees is paid. It is not that I have failed to pay 10 rupees. It is, we have agreed that I will not pay the 10. Hence, I feel that ITC reversal is also not warranted.
Thank you, sir.
Yeah.
That was the stand which I was also thinking only in that perspective, because there is no loss of revenue to the government. So there is no requirement for a reversal of ITC. Thank you.
Correct.
Thank you for passing.
There is a question. If
Yes,
I
sir.
pay my balance tax voluntarily through DRC-03 for previously not reported sales during the return filed, where shall I show the liability in GSTR-9? In GSTR-9, there is no possibility of showing our DRC-03 numbers. In 9C, only we need to show that. So in 9C, we have to show table 9. We have to include it, and then we have to mention in the remarks below table 9 as well, in table 10, that these DRCs with the reference number so and so have been made, the payment have been made through these DRC-03s to fulfill this obligation of liability. So that has to be reported only in GSTR-9C. There is no way of reporting that in GSTR-9.
And with respect to deemed supply, which is to be reported separately, is it logical to report all the other income which is coming under the purview of GST under this category and reporting turnover separately? I mean, my question is slightly hypothetical. See, I have a turnover, this so-called my profit and loss account shows a turnover of say 20 lakh rupees, hypothetically. And I have other income which is liable to GST, say 5 lakh of rupees. Do you have to report this as other income or do you have to report it as part of turnover?
If it is deemed supply, then only we are going to invoke the 9C deemed supply column.
Oh,
if
fine.
it is your other income, let's say for example, it is an interest income. Now in that case, we will still have to report it only under exempted, depending upon what is the nature of it. It could even be.
No, I'm
profit on sale
talking
of
about
asset.
a taxable supply coming under other income. See, supposing
Taxable
like
supply
these delivery charges, adhe mari da vechukonglen.
A taxable supply coming under other income. Okay, how I deal with it is when I report it in 5A, I don't take only the turnover, I take the total income for reconciliation. So it is not the operating income alone that is taken or operating turnover alone that is taken for reconciliation. In an income and expenditure kind of format, which is the current AS or Ind AS preferred format, whichever it is, So we take up the total, including the other income, and then do the reconciliation. Right. When we do that, even the other income or whatever way it is arising will get reported.
Forms a part of the turnover.
Exactly. And there, profit on sale of asset will also form part of that.
Exactly. Because
so which I'll be able to adjust as per section 15 valuation line and then report it and still be able to reach the reconciliation properly.
Okay. Thank you. Thank you, sir. As usual,
So one more question in the chat box. I'll read it, sir.
Yeah.
Since purchases are authenticated in GSTR-9, can the client maintain the purchase invoice on soft copy or physical copies to be maintained?
Okay. Physical copy of the invoices are anyway records that have to be maintained, because there is no dispensation with respect to maintenance of physical records. So that invoice copy shall have to be maintained. It is getting authenticated in 2B or 2A, because for 2021 we still have to talk 2A language only. Getting authenticated is a proof, or what we can say is that it is the evidence that department may not further probe as long as it is matching. It is something like in 2007, 2008, we had both physical form 16A as well as 26AS in picture. So after a period of time, we realized that physical form 16A is something which is irrelevant. So even if the client doesn't give us, if it is reflecting in 26AS, we were only going by that. I think we will reach that stage very soon. But this will be that twilight zone where we will have to maintain the records as well as see the reconciliation. Maybe 2 or 3 years down the line, this may even be legalized by the department. But as of now, maintaining that record is mandated.
Sir, one last question from my side.
Yes.
What is the relevance of a reconciliation statement when the third party is not going to attest it?
Which is why I said that reconciliation statement. Okay, that reconciliation statement, I will tell you the if a person decides to prepare legitimately that reconciliation for the department, it is of immense use. I had a discussion with one of the C&AG officers once. So he was telling me that the reason why GST, the C&AG was preferring to bring was that one taxpayer in Maharashtra had cheated the department to the tune of around 600 crores. Now, how did he manage to do that? He was present in Tamil Nadu, Kerala, Karnataka and Maharashtra. All these states had VAT audit. In spite of having VAT audit, how did he manage to do that was the question, for which they found an answer that that person was reporting and saying repeatedly that in Tamil Nadu, this is my Tamil Nadu turnover, and compared to P&L, everything is my other turnover. That is turnover pertaining to other state. And he will go to Maharashtra and say, this is my Maharashtra turnover and remaining everything is other turnover. So a Maharashtra state tax officer or a Tamil Nadu state tax officer will not take pains to see what is the breakup of that other turnover.
Okay.
Hence, what would have happened is that he would have reported only 1,000 crores to all the 4 states, but in his P&L, he would have carried 1,600 crores. To eliminate that, if you look at 9C, if a person says in table 5A of 9C, this is my turnover for this GST number, the officer is very well empowered to ask him, give me all the GSTR-9Cs of other states. If he gives that, if he totals the 5A alone, 5A, that cell alone, he totals for other states, it should match with this P&L.
Correct.
If it is not matching with this P&L, immediately they can initiate any kind of action against them, saying suppression of turnover. I think that is from that perspective, that reconciliation is of immense use to the department, provided the taxpayer religiously prepares that. Like what we discussed a few minutes back. Is he going to take only the turnover or is he going to take the total income? Things like that, if he does properly, then 100% this 9C is a useful tool in the hands of the GST department.
Okay. But as people who are doing without signature, we still be doing the same work even this year.
Absolutely. We will still be doing only the DSC effort of 3 minutes is saved.
DSC part of 3 minutes is saved.
Yes.
Thank you. Thank you so much, Shankar. Thank you.
Sir, I think we have we can wind up the session, sir.
Sure.
If there are any questions, members, you can please mail us, mail to the branch so that questions will be forwarded to the speaker. So on behalf of Chengalpattu branch and all other members, I thank you very much, sir, for the wonderful session today. Though we have been discussing this GSTR-9 and 9C for the past 3 years, but still today we had the opportunity to understand few more gray areas today, very important and very specific areas today. So thank you very much, sir, for sparing your precious time with this, despite your busy schedule. Thank you, sir. Thank you all the members for your participation today.
Thank you, sir. Swadhika. லீவ் மீட்டிங் கொடுங்க ஸ்வாதிகா.
சார் மேம் என்ன மேம்
லீவ் மீட்டிங் கொடுத்துருங்க மேம்.